Welcome to Fisher Webinars. The following is a recording of Where is the next pulp and paper industry merger likely to occur? Originally presented on Thursday, September 18, 2014.
As Kelly said, we're going to talk about where we might see the next merger in the pulp and paper industry. First, let's start with a couple of disclaimers. Today I'm going to discuss some hypothetical mergers and acquisitions as a way of demonstrating how you can analyze a variety of what-if scenarios and how you might view some potential and future M&A activity. Now, I don't have any inside information to suggest that any of these hypotheticals will or even should occur. And, of course, we don't make stock recommendations, so you shouldn't construe any of the examples that I'm going to use today as a recommendation from us to buy or sell the stock of any company. And all of the analysis that you're going to see today was done using FisherSolve or other publicly available information, which means that if you're a FisherSolve subscriber, you could do this type of analysis yourself. Okay, so let's start with a bit of an overview. So we know that the value of any firm is tied to its ability to produce a growing stream of cash flow. So in valuation, we think about really three elements. One is the base level cash flow, the risk associated with that cash flow, and the growth prospects for that cash flow. Those are the three things that really determine the value of a company. But in flat or declining markets, like many of the markets in pulp and paper are today, where is a company going to find that growth that fuels that value? We also know that fragmented markets, particularly those markets for commodity products, often are somewhat, my term, somewhat chaotic, but usually lead to less than optimal profitability for the participants. And you don't just have to take my word for that. Gosh, probably, I guess it's about 35 years ago, Michael Porter, who is a world-renowned strategy expert and professor at Harvard Business School, published his 5 forces model. And just a quick review, if you haven't seen this, most people probably have. Porter talked about how historically companies had looked at their direct competitors as really the only thing they needed to be concerned about. But he talked about these other forces on market. So the threat of new entrants, who else might be out there that could come into my market and pose threat to me? The threat of substitute products. What else could my clients use in place of what it is that I make? He talked about the bargaining power of buyers, or customers in this case. So if a customer has control over the suppliers, or the balance of power is shifted towards them, that's certainly a competitive force to think about. And then the bargaining power of suppliers. And the suppliers, one that sometimes is overlooked is a supplier, for instance, labor is a supplier to companies. And of course there are other raw material suppliers as well. So there's this inner working of these 5 forces that tend to affect, or that apply pressure and force on this rivalry among the competitors in a particular marketplace. And what Porter suggests is that as the intensity of that rivalry among competitors increases, profits are given away to customers or suppliers. They are not able to be retained by the participants in the marketplace. Well, again, Porter presented that 35 years ago, I think, but in the last few years, he's revisited this topic and updated it. And he talks about the intensity of the rivalry being at its greatest when there are a large number of competitors in a particular space, and they're all kind of roughly the same size, and no particular leader is exhibited. There's no one that has any particular ability to exercise any power in the marketplace. And when that happens, boy, competitors just cannot resist the temptation to go out and poach business from competitors. And without that industry leader that Porter talks about, what you would see as desirable practices for a healthy industry for all participants, including, of course, customers, kind of go unenforced. We also see that the intensity of that rivalry among competitors is at a peak when industry growth is slow. So slow growth really fights for market share. So is any of this sounding familiar? He also talks about the intensity of that rivalry being enhanced when exit barriers are high. Now, we often think about barriers to entrance into a market, but what about barriers to exit a market? And what we see is, particularly, and I think it's applicable to the pulp and paper industry, we have such a highly specialized set of assets that we're kind of in the paper business. When you're in the paper business, you're in the paper business. I joke with someone that you can't make iPhones on a paper machine. It's a very specialized piece of equipment. There's also something to this idea that maybe sometimes for companies it's just kind of in our DNA. This is what we do. And so getting out of a business is often very difficult to do. And so because it's difficult to exit a business, companies stick around. And they stick around in a market even when things aren't going so well. So they could be earning low or even sometimes negative returns, but they're not able to exit the market. And because that capacity remains in use, the profitability and health of the entire market suffers, because even healthy competitors suffer when the sick competitors hang on. Now, Porter also talks about this tendency to use price as a weapon in markets. And he says that that's most likely to occur when there's not a lot of differentiation between the products, and so there's not a lot of switching cost when the actual nature of the product itself is not what differentiates itself from the competitors. And so when that happens, it just encourages price cutting to go out and take market share. And of course, you know, for the last 30 plus years or maybe longer, we've certainly seen that play out in the airline industry. We also see price used as a weapon in markets where fixed costs are high and marginal costs are low. So what happens, and I've heard people talk about this, is there's this intense pressure to go out and get business. If I can get an order that is above my variable cost of production, those dollars go towards covering my fixed cost. And so I might have a tendency to look at that as a good order because it's helping to pay the bills. And Porter actually points out the paper industry as an example of an industry where that is fairly commonplace. And we also see price used as a weapon in markets where capacity has to come in large increments. Now, we certainly see some creep capacity in our business, but a lot of times capacity has to come online in big chunks. So when that happens, it throws the supply-demand balance out of whack, which then leads to this incentive to go out and use price as a weapon to fill up that new capacity, and the cycle starts all over again and just results in some fairly unhealthy environments. Okay, so let's go back to our overview. So we know that this fragmentation is an issue. What we also know is that consolidation via mergers and acquisitions can provide not only opportunities for some new cash flows, but it can bring some calm to the chaos by reducing that amount of fragmentation. And so we've got some M&A activity that's been going on in our business, and so, you know, Verso and NewPage merger has certainly been getting a lot of press lately, so we'll think about that. But with that thought in mind, where might we expect to see the next big deal? So today we're going to do a few things. We're going to just briefly review the Verso NewPage merger. We'll talk about maybe some other activity that's in the works right now. We'll outline a process for you that we think can help you identify some potential M&A activity. I'll walk you through the implications of some hypothetical mergers. And then, as Kelly said, we'll have an opportunity to answer some of your questions. So just remember, as we're going along here, if you think of a question, go ahead and submit it. Kelly will collect all of those, and then when we finish, we'll get a chance to take a swing at as many of those as we can. Okay, so as we jump into this, let me first give you a definition. You're going to hear me talk today about the Herfindahl-Hirschman Index, or HHI. And if you're not familiar with this, it's a measure of market concentration. So industry regulators and observers use this HHI measure to evaluate the competitiveness of a market. Now, it's a mathematical formulation, so you calculate it by taking the market shares for each of the participants, you square that, add all of those up, multiply it by 10,000. That's your HHI. Well, if you're not dizzy from that, just stick with me. It's once you see it on paper, if you haven't done it, it's pretty easy to do. But just think of it this way. If you had one participant with a 100% market share, the HHI would be 10,000. So that's a fully concentrated market. And in the United States, the Department of Justice uses HHI as one of the measures when they're evaluating merger and acquisition activity. So what they've published some guidelines, and they say that a market with an HHI below 1,500 they consider to be unconcentrated, and a market with an HHI above 2,500 they consider to be highly concentrated. So I wanted to give that as a definition. You'll see that referenced several times during today's talk. Okay, so let me give you a couple thoughts on the Verso NewPage merger. We get asked an awful lot about this. And so when I think about this is in coated papers, pulp, and coated groundwood. And so you see coated freesheet here, coated groundwood is the biggest chunk. This communications, we recently reclassified C1S label into this, so there's some C1S label in here as well, and perhaps some other specialties, and here's some uncoated groundwood. So what I've seen, I think, is you certainly, there was a time when you made an argument that these were all pretty distinct markets, but I think over time what we've seen is there's a blurring of the lines between some of these printing papers, for sure, between coated freesheet and coated groundwood, and maybe even some uncoated groundwood grades, that there's some interchangeability, that customers are willing to use grades, substitute one grade for another. So I think that it's reasonable that we could consider all coated papers and super calendared uncoated grades as one market. And so if we do that, this is just in North America, if we consider all coated papers and super calendar grades as one market, this is what that market looks like. It's a little north of 10,000 short tons. Okay, so back to HHI. What I've done here is I've prepared some comparisons of prior mergers. The purple is the HHI level before the merger, and the orange is the HHI level after the merger. This is the several years ago when Domtar acquired Weyerhaeuser. This is North American uncoated freesheet, Abitibi-Bowater, North American newsprint. This is North American linerboard when IP bought Temple Inland. And then here's this proposed Verso NewPage merger. And so what we see is, if we consider that all coated papers and SC grades are really one market, this deal falls perfectly in line with precedent that we have seen in other mergers, both in terms of the increase in HHI and then the absolute level afterwards. But this is not the Verso NewPage is not the only merger that's pending. There's another merger or acquisition that's in the works in the uncoated or in the recycled board business. Now, what I've shown you here on this chart is just the uncoated recycled board market. This is things like tubes and cores, wall lining boards for used in housing, other types of uncoated recycled product. And what you see here is a market that we would consider to be unconcentrated. You also see that Sunoco has the largest share at 25%. But going back to Porter's comment about leadership in a market and how if everyone's kind of the same size and no one's really large enough to exercise any leadership, that leads to some dysfunction in the market. And what we see is that markets where the leading participant doesn't have at least a 30% share, we see that they are less disciplined and less able to balance supply with demand. So we do think there's a threshold to get to that true market leadership, and it's about a 30% share. So what we know is that, I think it was in July, Caraustar announced their intention to acquire the Newark Group. And so here I've used the M&A scenario planner tool in FisherSolve to pull those two companies together. So I just brought all of the Newark assets into Caraustar. And so this is the same chart, same tons, but now what we see is the HHI is 1,500, still just above the threshold of what we would consider to be concentrated, but I would still say this is a somewhat fragmented market. But you also see that there's not a leader with 30%. So Caraustar's acquisition in Newark doesn't get to that 30% threshold. So what I would say about this is this merger will help in this marketplace, help reduce some of the fragmentation, but it leaves some more room perhaps for some future consolidation in the market as well. Okay, so who's next? Where might we expect to see the next merger or acquisition? Well, let's talk about some clues that we might use to help us think about where that might come. So we would probably look at markets that are mature, either growing very slowly or not at all. Of course, that doesn't mean that fast-growing markets and developing markets won't have M&A activity. That's not what I'm suggesting, but this is clues where you might want to start looking, so those types of markets. As we mentioned earlier, where product differentiation is not really the driving value proposition, which makes switching costs lower for customers. Where we're not at the regulatory maximum concentration level, so those HHI levels allow some headroom. Now, again, different markets around the world, regulators will have different metrics that they look at, but if you think about that, that's probably a good, HHI is a good one to think about as you are considering that. We might look for markets where there's an opportunity to eliminate redundant costs, right? Or maybe an opportunity to impact market dynamics. So let's go back to talking about growth for a minute. And we know that growth rates vary quite dramatically, not only by region, but by grade as well. Look at this top line. This is the Asian talon tissue market that's been growing at about a 12% combined annual growth rate since 2002. So pretty fast growth, as opposed to the North American newsprint market, which has been declining at about 6.5% a year. So there's a really wide variety of growth by region and by grade. So let's just zoom in on this group of markets and do a little further examination of that. So this is the same chart, or the same markets, just a different chart and a different view. This just shows those growth rates. And, you know, North American newsprint, I don't know that companies would be racing to get into this market, so I wouldn't expect to see a lot of M&A activity there, but you never know. This just shows that really none of these markets are experiencing what you would consider exceptional or maybe even acceptable growth in recent years. So let's talk a bit more about this fragmentation. So what I've done here is I put together a chart that shows the top 10 grade categories on a global basis. So these are the by tons of production. And I've just focused, just for the sake of readability on the chart, I've just focused on 3 regions here, North America, Europe, and Asia. And I said, how many companies operate in this space? So for instance, in linerboard in Asia, there are 187 companies making linerboard in Asia. There are 132 companies, not plants, companies making in the linerboard business in Asia. There are only 23 in North America. Now, I suppose that you could make an argument that we need to put this in some sort of context, because maybe some of the markets are a lot bigger in a particular region, and so that's why you would expect to see more players in that market. But one way that we can add some context is going back to this HHI metric. And so what we see here, the HHI measure in Asia is very low, and it's very low in Europe as well, particularly compared to North America. North America is more than 4 times as consolidated as the European or Asian linerboard markets. So this would be another area that we might look to for clues, is the number of participants in these larger markets. Now this is another view where I've just taken the markets where the HHI level is below 1,500. So we would consider these markets at a low level of concentration. And so this might also be a clue. Now here I've just focused on North America, Asia, and Europe. So these are the markets that are below that 1,500 HHI. But as we think about this, and particularly some markets on the left end of this scale, would consolidation have a meaningful impact? And let's take a look at this Asian uncoated freesheet market for an example of that. Well, wow. This is the Asian uncoated freesheet market. Where in the world would you begin if you were going to try to consolidate this market? I mean, the market leader has a 10% share, and the top 4 firms only have a quarter of the business, a quarter of the production capabilities. And this was striking to me. Almost a quarter of the production of uncoated freesheet in Asia is in the hands of companies who have less than 1/2 of 1% market share. That's pretty striking. But of course Asia isn't one big giant market, so let's just narrow our focus down and look at China. Well, it doesn't look a lot better. It's still a very fragmented market. So if you look at this and you say, well gosh, would the uncoated freesheet market in China, is it going to consolidate? Well, of course it's going to consolidate eventually, but merger and acquisition activity isn't the only method of consolidation. As this market matures, bankruptcy, voluntary exits, along with M&A activity, will eliminate some number of these participants in the market. Okay, so let's revisit a discussion that we started with you a while back regarding the European coated wood-free market. So last fall, we published an article that we titled Troubling Times in the European Coated Wood-Free Market. And in this article, we kind of laid out the state of the market at the time, and we hypothesized about a potential solution. So this time last year, in Q3 of 2013, the European coated wood-free market was certainly fragmented, no market leader, as you can see here, and in decline. In fact, operating rates were in the low 80s, and so the need for capacity reduction was pretty obvious. Something needed to happen here. So let's fast forward today, and we see that a year later, coated wood-free producers in Europe have taken about 325,000 tons out of the market. So are we making progress? Well, not really, because about 50% of that coated wood-free capacity reduction came from either curtailment or a shift to uncoated wood-free. In fact, until just a couple of weeks ago, almost all of that had come from curtailment or a shift to uncoated wood-free until Verso announced the closure of their Avezzano mill 2 or 3 weeks ago. Almost all of it had come. That Avezzano mill had been a coated wood-free producer. They shifted it to producing uncoated wood-free, just lifted the coaters, and then recently shut it down. So the reason I make this comment about a shift to curtailment or uncoated, just making another product, I think that's significant because we go back again to Porter's comments about capacity not coming out of the system. So if we just slow down the machines or we don't operate at full capacity, we only run 100 days instead of 200 days or something like that, then that capacity is not really gone, and there's the temptation remains for us to go back and revitalize that capacity at the first sign that things are better. So the point I want to make here is that the capacity isn't gone until it's gone. So let's look at this market in another way. Last year, there were 75 machines making coated wood-free in Europe and 33 different companies in that space. Today, there are 74 machines making coated wood-free and still 33 different companies. So in the past year, we've had 2 machines that shut down, but we had 2 started making coated wood-free. And again, this includes C1S label. And 1 made what we would consider to be a permanent grade change that is probably irreversible. So back to this idea of the market is running in the low 80s from an operating rate perspective. If you think about how we would need to balance supply with demand, that means that well over 1 million tons of capacity still need to come out of this market. But where's it going to come from? Because no single player has enough capacity to take that out without rationalizing themselves right out of business. So there's no way that we could expect this problem to be corrected with the actions of an individual player. So it seems like some sort of significant merger might be required to address this issue. All right, so here's one of these examples that I told you we were going to hypothesize about. So we used the scenario planning tool, M&A scenario planning tool in Fisher Salt to pull together Stora, Sappi, and Verso. And so we've created this large entity here. And so this new entity certainly would be large enough to rationalize capacity. It would have enough capacity to affect the market. Now, I'm not suggesting that this would be easy or that this would be painless. It's not going to be painless. But when you have this sort of imbalance in a market, something's going to have to happen, and I think market forces would tell us that something will happen. It's just a question of how and on which terms. So if this new entity is large enough to rationalize capacity, that's great. But where is that capacity going to come out? Which capacity gets rationalized? Well, this is a view that might help us think about that. Here's one chart where we're looking at 3 different elements. We're looking at the risk, cost, and carbon profiles of the individual mills that would be owned by this combined company, where we might get some clues. So a little further explanation. This y-axis is our site viability index, where this is a measure of risk. We'll talk a bit more about that in a few minutes, but so the lower the number, the lower the risk. The higher the number, the higher the risk. The x-axis is the manufacturing cost per ton in euros. The size of the bubbles represents the CO2 emission per ton of production. So a larger bubble indicates a larger amount of CO2 emission. So I kind of put a little crossroads here. This is the midpoint of both viability and cost by production of tons. So again, 50% of the production is at a viability index that's below this line. 50% of the production is at a cost that's to the left of this line. And of course, you can infer from that that just means these sites are really big sites. So half the production is in a small number of sites. So in this upper right-hand quadrant, we might find some candidates for rationalization. These would be sites that certainly have higher costs and higher risk, and then we might look at some of these larger bubbles and say those are sites that are emitting higher levels of CO2. Now, that doesn't mean we would or should or need to close all of these sites. We don't. But we need to do something, and maybe this would be a good place for us to start if we were looking at which sites might get closed. Okay, so we've extended this hypothetical consolidation now to include this hypothetical capacity rationalization. And granted, it's a pretty extreme measure, but we're dealing with a pretty extreme problem here. So we now see this SAPI Stora SAPI Burgo entity that we created, and we took out about 1.2 million tons of production, and this leaves us with a market where if we were to do that, if this were to happen, that reduction would bring operating rates into the mid-90s, a much more healthy rate, but it also leaves this new entity in a leadership position with the ability to continue to lead into the future. And that's important because this decline in demand for coated wood-free papers would not stop the day this happened, right? I mean, that's going to happen. That's going to continue into the future. So the market needs to be left with an industry leader who is capable of responding to the future needs of balancing supply and demand as well. I also think it's interesting to think about the effects on all of the constituents in this market. So, you know, it's pretty obvious that a consolidation and rationalization would affect the other participants, the competitors, affect customers, investors, and whatnot, but it certainly would affect suppliers too. So here's a look at, I just picked an item. This is latex purchases in Europe. So today, there's about 660 million kilograms of latex that's purchased by participants in the pulp and paper industry in Europe. But that rationalization and consolidation and rationalization we just presented to you would result in a 5% reduction in the amount of latex used in Europe. That's a big deal. And it would also mean that this combined company would now be responsible for more than a third of the latex purchases in Europe. So back to this notion of the five forces and the powers of buyers and sellers. So I just thought this was interesting that these hypothetical mergers certainly have ripple effects throughout the chain. Okay, so what about some other markets? Well, on one of the earlier slides you saw European linerboard. So let's dig into that a little bit. So if we look at the European linerboard market, we see that it's very fragmented. The top 4 firms have about 35% share, and the HHI is 506, as we said earlier. And kind of like the uncoated free market in Asia, we see a whole lot of firms, about over a quarter of the firms that have very small market share. So pretty fragmented market. But again, Europe's not really one market. You have Eastern Europe, Western Europe. So let's just focus in on the European Union. If we do that, we still see a very fragmented linerboard market. Top 4 firms have 41%, and HHI is still only 719. There's no clear market leader. And it's particularly striking when you compare that EU market with the North American linerboard market. We see that the North American linerboard market, the production in North America is about 50% greater than it is in the EU, but it's a much more consolidated market. The top 4 firms have almost 80% of the market, and the HHI is 4 times the level as it is in Europe. We see IP clearly as the market leader in this space, so quite a different picture when you compare that to the EU market. Now, let's narrow our focus a little bit more. The next few slides, I'm going to narrow the focus to just talking about recycled liner. And about 60% of the market in Europe for linerboard is recycled. So let's just kind of zoom in on that particular market for a few minutes. All right. So I told you we'd talk a little bit more about benchmark viability. Let me explain what we're looking at here. So Our benchmark viability tool considers, think of this as a measure of the long-term competitiveness of an asset. So a machine or a group of machines in a site or a group of sites in a company. And today's cost of manufacturing certainly is one of those elements that determine the competitive position of a machine, a mill, or a company. But we add that together with other elements like size or scale, age. This is the age of the assets, so think of this as asset quality, and capital requirements. How much money is needed to keep this business running, keep these assets running. So we weight all of these factors, we combine them together into an index, we assign a value. 0 is very low risk of failure, 10 is very high risk of failure. So what we're looking at here is a risk profile of the machines making recycled linerboard in the EU. And I would say that this is pretty much what we would expect to see. About a quarter of the production is on machines that are at low risk of failure, and about a quarter of the production is on machines that are high risk of failure, and of course everything else is in the middle. But look at this. Almost 60% of the companies making recycled liner in the EU are at high risk of failure. And of course that's just a function of there's a very large number of small companies operating in that space. So what happens if some of those companies start to fail? Well, let's back up. So here we're looking at a cost curve for recycled liner producers in the EU. This is at the company level. And so I've just highlighted the top 6 participants. The width of the bar is the tons of production. So we see the top 6 participants. We see that Smurfit Kappa is the largest participant in the market. But we also see that Smurfit Kappa has the highest aggregate cost, or their average cost for producing linerboard in the marketplace. We also know that markets tend to establish what we call a floor price. And that floor price is usually right about the midpoint of the 4th quartile cost. So the quartile lines here are drawn by production. So 25% of the production is at a cost below this line. 25% is at a cost above this line. So we look to this midpoint of the 4th quartile to find the floor price. Now the pricing of recycled liner in the EU is not on the floor today, and that's obviously a good thing, because a market cannot tolerate prices on the floor for long. What happens is these higher cost producers, if the price gets to the floor, the higher cost producers are essentially writing a check to their customers for the privilege of producing product. Well, let's think about what happens if new production comes into this market. And let's say that we're the largest player in the market in Smurfit Kappa, and we say that there's some new production that comes in at a cost that's lower than ours. And I've kind of simulated that. I've brought in about 750,000 tons of new production. I just kind of made up a few companies that would be new entrants into the market and placed them to the left of Smurfit Kappa on the cost curve. So what might happen is if this new production comes on, it might drive out this production that we saw earlier on the right-hand side. So that new production lower cost production might force the production on the right end. 750,000 tons comes in, 750,000 tons might exit on the right-hand side of the cost curve. If that happens, the floor price drops down to this new level, the new midpoint of the 4th quartile of production, and now it's much closer to Smurfit Kappa's cost of production. Well, if the growth in the market starts to slow, we know that market prices will begin to be driven down towards that floor price. And if that happens, Smurfit Kappa is going to need to find a way to lower its cost, to move to the left on the cost curve to be able to maintain its margins. Now this is a neat chart. This is a chart that shows the stock performance of Smurfit Kappa, Mondi, DS Smith, and then a couple of broader indices, the S&P 500 and the FTSE, over the last couple of years. And so if you own stock in any of these three companies, you're probably pretty happy. They've all done pretty well. But if you own Smurfit Kappa stock, you're really happy. Your investment's gone up over 125% in the last couple of years. So is it possible that Smurfit Kappa might capitalize on that value of their stock and use it as currency to engage in some M&A activity? Well, in fact, we know that's going to happen because Smurfit Kappa has told investors that they do plan to go shopping. And in the last investor presentation that I looked at, they have said, yeah, we plan to go out and engage in some M&A activity, and kind of detail the plan for their approach to doing that. So if Smurfit Kappa were to go shopping, who might they go looking for? So just for argument's sake, I just took those same 6 companies, and one of the things that they might consider when they go shopping is, who are some companies that have complementary product portfolios? And again, lots of companies in the space. I just picked these top 6 to make the point. So this is all of the tons and the grades that Smurfit Kappa makes, and then the same for these other 6 companies. So when I talk about complementary product portfolios, which product portfolios kind of match what Smurfit Kappa already has? You see here, Mondi, for example, has a pretty significant presence in the uncoated freesheet market. Smurfit Kappa has a very small presence, but not much of one at all. And so you can look at how these other companies' portfolios might complement Smurfit Kappa's. Let's go back and think about this benchmark viability again, and let's think about the quality of the assets. So one of the other things that Smurfit Kappa might do is it might say, well, who could strengthen the quality of our assets? Now, I've put together a viability curve for just those 6 companies, but I've included all containerboard assets. So this is sites that are making both linerboard and corrugated medium, and I plotted them on here by their risk. So these are low risk, moderate, high risk. And one thing that kind of jumps out at you is you see that a lot of these companies have a pretty broad distribution across this risk profile. But there are 2 companies, Pro Group here in the yellow and Seika in brown, that only have assets that are low to moderate risk. They don't have any high risk assets in play in this space. So let's just say that Smurfit Kappa decided they wanted to acquire Pro Group and Seika. And once again, I've used the M&A scenario planner tool to simulate that merger. And we see here that acquisition would make Smurfit Kappa, the clear leader in the EU linerboard market, get above that 30% threshold that's important to be able to exercise market leadership. And buying those 2 companies certainly improves Smurfit Kappa's cost position. You remember earlier, they're over here in 4th quarter. They moved considerably to the left, and obviously that's because they bought companies who each had lower cost positions than their own. This hypothetical acquisition also improves Smurfit Kappa's geographic reach. It gives them additional production facilities in 5 of the 6 largest economies in Europe. So these red triangles are Pro Group sites, green ones are Seika, and the blue ones are Smurfit Kappa. Okay, so let's start wrapping up here. So we know that M&A activity is driven by a number of factors, more than what even we talked about today, but some of those are a need for growth, right? M&A activity is driven by a need to eliminate redundant costs and increase margins. It's also driven by a need to bring discipline to a market by reducing fragmentation. And we've shown how examining market dynamics can provide some clues as to where you might expect to see some future M&A activity. And again, we focused on some markets that are particularly fragmented or slow growing because those are certainly ripe for consolidation. And we've shown in some of the charts what some of those other ones are, in addition to the ones that we detailed a bit. But remember, those aren't the only places certainly where M&A activity could happen. It's just maybe a good place to start looking. And I think it's also true to say that M&A activity is going to be a factor in our business for many years to come.